Hello again. Welcome to another episode of the Uranium Market Minute. Today is Tuesday, December 14th. This is episode number 50. My name is Justin Hune. I'm your host. I'm the founder and publisher of the Uranium Insider Pro newsletter, the only investing newsletter that focuses solely on uranium and publishes on a regular monthly basis. Thank you so much for tuning in. I can't believe we made it to 50 episodes. Really appreciate everybody here. Thank you so much for all the great comments and all of the support. It doesn't go unnoticed. If you've been liking these videos, please like this video. Please subscribe to the channel, hit the notification bell. You will be notified whenever we publish a new episode, which is just about every day. I again apologize for my voice. I'm still a little bit congested from getting over the cold from last week, but I will muddle my way through it. And before we get into the content of today's video, nothing is intended to be investing advice. I'm not your financial advisor. This is not financial advice. Please always do your own due diligence when it comes to investing. Always take responsibility for your own choices. Let's jump right into the daily scoreboard here. The spot price of uranium coming in currently at $43 a pound mid-market, essentially unchanged from yesterday. Again, it's been very, very quiet out there during this period of inactivity from the Sprott Physical Uranium Trust, as they've continued to trade at a discount to NAV. Still a pretty steep discount to NAV. They closed yesterday at a minus 6.14% discount to their net asset value. And today, with the actual trust dipping quite a bit in the market, with the spot price essentially staying flat, they were pushing a 10% discount to NAV, but I think that pulled back a little bit. Either way, it's nowhere near where they need to be, that 1% premium to NAV, in order to issue new shares into the market and raise some money in order to buy physical uranium. However, though they did not purchase any uranium yesterday, they still have $30 million in cash. Since the 17th of August, when their ATM went live, they purchased 22.9 million pounds of U3O8. They've raised almost $1 billion. Again, they have a 3.5 billion allocation. It looks like everybody is just kind of like out of the market here, letting things just kind of simmer and slightly fall on low volume. Looking at the ETFs, yesterday URA reported redemptions of 100,000 shares. URNM reported a decrease in 25,000 shares. That outflow gave rise to 3.5 million in mandated selling, really not all that much. However, considering the weakness in the sector, the two ETFs fell a bit more yesterday and into today, continues to drip down on lower volume. That portfolio depreciation being the major contributor to a decline in AUM further by another 53.5 million yesterday. The two AUMs combined are just under 2 billion at this point. Let's take a look at the charts. Starting off, as always, with URA, the largest ETF in the uranium space in terms of market cap and liquidity. Another just average volume day. It opened down, recovered from the lows of the day. We only have about 10 minutes left of trading here, so likely we'll close in this range. It's down 1.88% currently. Just not a lot happening here. The volumes are really mediocre. They're not nothing, but they're not, really something to write home about. Looks like like I've said the past few market minutes, a trip to the 200 days looking likely. We almost touched it today. A lot of the equities in the space did hit that 200-day moving average or got very, very close. And I'm going to discuss the significance of that in the mailbag section today. But for as far as technicals go, it looks like we're just going to continue on this path of pulling back to that reversion to the mean, back to that 200-day moving average. Indicators look like they're just about as low as they could go on the MACD here. RSI has a little bit more to go, but things are looking like we're definitely close to a bottom, at least as far as the indicators go. And technically speaking, this has been a pretty large pullback from those recent highs mid-November, about a 35% pullback here in URA. As I mentioned in a previous episode of the Market Minute, where I brought up Dennis and Mine's chart from the previous market, just to show some examples of the types of volatility that we could see in the coming bull market. You can see these pullbacks that we're experiencing. And of course, there were much smaller pullbacks, between these pullbacks, but this is over the course of mid 2023 to 2027. So 3.5 years, we saw at least one big pullback every year. 54% pullback right out of the gate, less than a year into the bull market. 35%, 39%, 47% was the pullback from this high point to the low point. But this total downward consolidation happened. It took a good part of a year. And so we had really, really big pullbacks. But this, of course, was Denison Mines going from, 35, 40 cents all the way up north of $16 over that 4-year period. So just to kind of highlight volatility and the type of volatility that we can expect in a bull market. It's just really, really something that you have to expect going in so it doesn't catch you off guard. But we can also look at the 200-day moving average during this period of time. Almost touched it on that 54% drawdown. These other smaller drawdowns didn't quite get there, but a lot of visits to the 50-day along the way. Another one to the 200-day. This longer consolidation period, it lost the 200-day, but interestingly enough, we only had a period of about 3-4 months where the 200-day actually even pointed to the downside and started to flatten out a bit. That, the 200-day average moving up is really the ultimate classic indicator of a bullish market. And so this pullback and this long period here was definitely gut-wrenching for investors, and just something to kind of keep in mind as we experience the pullbacks that we are currently. Sprott Physical Uranium Trust had a pretty substantial down day today. Like I mentioned, considering that the spot price did not really move today. However, we did see some dip buying come in, which is good. Actually, chunky volume here. So it looks like there's some decent money coming in, taking advantage of that almost 10% discount to NAV that we experienced intraday here. So good to see this hammer print on the daily, even though it was a 3% down day for the trust. We likely are still sitting at around 8 or 9% discount to their net asset value. So no money raising anytime soon. However, clearly there was some decent money coming into the trust to take advantage of that discount to NAV. So yeah, for the mailbag section today, instead of taking a question, I am going to just speak really quickly about the significance of the 200-day moving average and the reversion to the mean. So the 200-day moving average, which in terms of the way we're going to discuss it today, it's a simple moving average. It's a technical indicator that represents the most recent 40 weeks of trading, considered a key indicator by traders and market analysts for determining overall long-term market trends. So where the 200-day moving average sits currently, that is the average price of that stock over those past 200 days of trading. Maybe that's obvious, but it's probably worth reiterating. The indicator appears as a line on a chart, meanders higher and lower along with longer term price moves in the stock, commodity, or whatever instruments being charted. 200-day SMA, or simple moving average, seems at times to serve as an uncanny support level when price is above and a resistance level when price is below it. As we just saw, and I didn't go through all the equities charts, obviously, but most equities charts in the uranium space are above their rising 200-day moving averages. Another important concept is drifting back to the 200 DMAs during a bull market is a phenomenon known as reversion to the mean. What that means is essentially when a security gets stretched too far above or below the 200-day moving average, there's a strong likelihood but at some point, like a rubber band that stretched too far, it tends to revert to the mean and revisit the 200-day. We already saw that happen once earlier this summer. Clearly, it's happening again right now. And to reiterate, the overall slope of the 200-day moving average, up or down, is indicative of the longer-term trend, which in the case of the uranium sector is up. So when you see the 200-day moving average rising, that really is the most simple, the most classic indicator that the longer term trend is up, right? And the opposite is true, of course. And so what we're seeing right now, again, is just a reversion to that mean, a reset of sentiment, clearly. Just spend a couple of minutes on Twitter, you'll be able to tell where the sentiment's at currently. We've got broad market fears abound too, which don't help. But this, in our opinion, continues to look like a relatively healthy pullback, really get the hot money shaken out, reset things right around the holiday season and set ourselves up for the next year. Again, if I've mentioned this multiple times before, but if the volatility that you're experiencing in any investment, really uranium or otherwise, is very difficult to handle, more than likely either you're invested in the wrong space or your position sizes are too large. And so these are the types of moments that really kind of teach us about ourselves in terms of what type of investor or trader we are. And so in this type of environment, if you aren't used to experiencing these kind of pullbacks, they can be pretty gut wrenching. But if you are experiencing the resource sectors and you understand the types of volatility and you understand that upside volatility, it doesn't come without these types of moments either. You can't expect anything to just go up in a straight line. And if you want that outsized gains that we've seen this year, like I mentioned, up almost 6x compared to the broad markets and the outperformance of the ETFs even within this sector, but having that beta to average returns, let's say, or to the broad markets comes with a cost, and that cost is volatility in both directions. And so if you understand how resource markets work, how cyclicality works, and how volatility works in terms of shaking out weak hands, shaking out hot money, shaking out the tourists, this will happen over and over. And so pulling back to the 200-day is a classic, and it's something that we look for to continue to happen. It'll happen next year. It'll happen the year after that, at least once, probably both years, if not more. Like I said, it's happened twice this year. And as always, in any market, the best time to buy is at the bottom. Who does that? Very, very few people can time the very bottom. The second best time to buy, pull back on an uptrend. Market's giving you one. So if you're bullish on uranium, as I am, if you understand some of these fundamentals, if you understand that in the next 60 days, Sprott will be taking over the Uranium ETF. If you understand in the next 6 months, they're likely to have a New York Stock Exchange listing. If you understand that they have a 3.5 billion ATM allocation, that they're speaking with multi-$100 billion funds, they're speaking to $1 trillion funds, AUM, then you start to get an idea of what is being set up here. And the market is giving us a gift. So hopefully that helps. Hopefully everybody's doing well out there. It's a rare, very rare rainy day here in Southern California. So I'm really enjoying the gray skies and the moisture abound. I hope that everybody is having a decent time, even though with these pullbacks, and taking care of themselves and their family around the holiday season. And we will see you guys tomorrow. Thank you for listening. Cheers.